When people first start getting into trading or trying to be successful in trading, they start scouring the internet, looking for ways to become successful and finding the strategy that works. Usually what happens is they'll find a strategy because it looks successful and they'll start trying it. And then once they realize that it doesn't work, they immediately jump to something else and then start trying that. This usually looks like just trying different indicators, following technical analysis, and something that's going to be the new secret ingredient in order to consistently stay profitable with trading. And this really just puts traders in a downward spiral, or a black hole, if you will, of just looking for strategy after strategy after strategy and never really seeing any results doing that. And a lot of these strategies really are just following technical analysis. You see something called ICT or SMC, and it's really just relabeled technical analysis using different terminology. Or you look at something like an RSI or a moving average or a fib, and all, like I said before, all these indicators. It's really just following technical analysis, and you're still there struggling, most likely trying to figure out what strategy is going to get me to be profitable consistently. Maybe that's why you're here watching this video right now, because maybe this is what you think that's going to give you that consistency that you want. This is why over 95% of traders are failing. And that's not me just saying that random number. This is proven by statistical data. Now, technical analysis is important. You can use these for your entries. You want to use technical analysis for your stop loss placement, your take profit placement. You want to pay attention to price action. This is what's going to tell you when to take your trade and when to get out of your trade from a visual perspective when you're looking at charts. But there is a way to anticipate the possible outcome of whatever it is that you're trading, and this is called fundamental analysis. Fundamental analysis is just the type of analysis that helps us identify the value of something. That's all it is. If you're talking about a company, for example, like say Tesla, all I'm doing when you say what are the fundamentals, I'm talking about things like their revenue, which is how much money they make, their earnings reports, which is a report that they release every quarter. We're talking about their growth, we're talking about the economy, and we're talking about future expected growth of the company. Stuff like this is what the fundamentals would help predict, or not predict, but determine the value of Tesla, like a Tesla share. Or if you're trading gold or currencies, when you ask about fundamentals, you're looking at things like what impacts the strength or weakness of a currency, right? So if you're looking at the US dollar, this is obviously going to be the economy of the country that holds the US dollar and creates the US dollar. So I'm talking about things like economic growth, the labor market, inflation data, monetary policy, interest rates. It's a lot of technical, statistical data that you're looking at, but this is the stuff which is fundamentals that will impact the value of the currency. So for example, when the Federal Reserve speaks, which is for the US markets, that moves the markets, right? That's fundamentals. When there's economic data release, things like inflation or labor market data or NFP, also known as non-farm payrolls, when that's released, that moves the markets. This is what fundamental analysis is, understanding how that data or those speeches are going to impact whatever it is that you're trading. So how can you use fundamentals to create expectations on whatever it is that you're trading? Personally, I like to use a 3-step process. The first piece of the process is I want to understand market expectations. So let's use a real world example. If I'm looking at inflation data and I can see what the numbers are for inflation data, I know the expectations because there's something called forecast when you look at an economic calendar. So I know the expectations of the markets. That's number one. Number two is I need to determine if when the data is released, if it's going to be a surprise. So number two is surprise. Can I see if when the data comes out, is it a surprise lower or a surprise higher? This is what's going to give me a possible tradable opportunity, because when data is a surprise to the markets, this is when you have the best opportunity to take a trade. The way that I can see whether or not the data is a surprise to the upside or the downside is something called a news terminal, which you can see on the screen behind me. This is what gives me all of the data that I need, because if you go look on like free resources online, you're just going to see a forecast number on an economic calendar. But if you want to see the surprise lower or the surprise higher, you have to have something or access to a news terminal. And the third piece of this analysis puzzle is bigger picture. I want to know if this data comes out, I already know expectations, I know if it's a surprise or not. If it is a surprise, is it going to change the bigger picture? Now, what does bigger picture mean? I'm just referring to monetary policy. When you take a look at economic data is just sort of puzzle pieces for the central banks in order to determine what they're going to do with monetary policy. So if you're looking at data and I know it's going to change or shift the markets, this is what gives me the highest probability trades, because your better opportunities are going to come when you see a shift in monetary policy or a surprise in the markets. So I'm going to show you how to take a trade based on fundamental analysis. The Federal Reserve was about to announce their rate decision, and they hadn't cut rates in years. If anything, they just spent the last 2 years hiking rates aggressively. So the markets were borderline expecting a rate cut, and this was going to be a very important rate decision. You can see here, if you look at this little cheat sheet here that I have, these are my expectations, or these were my expectations going into the Federal Reserve's rate decision. The markets were expecting, as you can see right here, we had two expectations. We were 45% priced in for a 0.25% rate cut. Then on the other hand, we were 55% priced in for a 0.5% rate cut. If you see the BPS, that 50 basis point just means 0.5%. On this day, I was paying attention to trading gold. And if we got a 50 basis point rate cut, which is the 0.5%, you can see I have it right here. If we got the 50 basis point or higher, I would be looking for gold to go higher. This is because lower interest rates would make the dollar drop. You can see right here where I have this little arrow in the bottom, US dollar would drop if we have the 50 basis point rate cut or higher. There's an inverse correlation between the US dollar and gold. So if dollar drops, I'm expecting gold to push up. Now, if we got a 25 basis point rate cut, which once again is the 0.25%, you can see here that I would have expected gold to drop. Just to be clear, I put here short-term hawkish. It just means gold dropping. Now, the reason I would expect gold to drop short-term is because if you look here, we're still cutting rates. But because the rate cut is less than what the markets were actually expecting, I would look for a short-term drop. And then long-term, I would look just to get right back in on gold buys, which would just be this. As you can see, this cheat sheet that I have made, I had it done before the actual FOMC rate decision, so that way I was going into this with right expectations. I even have the recording live with all of this taken inside my private trading community where I trade live every day. So what was the rate decision that day? As you can see down here, this is my economic calendar from my news terminal. The Reuters poll, or the forecast, was 5.5 to 5.25%, and you can see the actual was 4.75 to 5%. Now, I don't want to make you do a bunch of math right now, but basically this is a 50 basis point rate cut, which is a surprise to the markets because they didn't know whether we were going to get a 25 or a 50. So if you look at this once again, 50 basis point rate cut, I'm expecting gold to push higher. If we take a look at this chart behind us, this is gold. And if we look at the time that the data was released, 1400 is just 2 p.m. Eastern time, and we match that with the time right here, also 1400, 2 p.m. Eastern time, and then we take a look at the reaction when the 50 basis point was announced, and you can see that gold, pretty aggressive push to the upside, right? So as far as just this initial move right here, you're looking at 200 pips. This is exactly what I was looking for when you see here a 50 basis point rate cut or higher is going to give us that gold upside. This is basically what trading using fundamental analysis is, anticipating how whatever it is that you're trading is going to move based on economic data, important announcements, and economic news. I hope this was helpful. Share this with anybody that you think needs to know this and it can help them. Subscribe if you guys want to see any more videos about trading, and I'll see you in the next video.